It may be turnaround time for some recent IPOs. Uber and Lyft have been struggling, of course, this year. But Mark Mahaney, who is with us this morning at the table, sees some signs of profitability. And he joins us right now. He is the lead internet analyst at RBC Capital Markets. We often get to see him through the window in the box. But now you're here. Live and in person. These are two stocks that have been battered. And you now like them.
We've had 7 internet IPOs this year. 6 of them have broken issue, have traded below their IPO price. All of them have underperformed the market year to date. If you believe in reversion to the mean, there's probably 1 or 2 in there that you want to buy on this kind of correction, and I think Uber and Lyft are 2 of those. They have both listened to the market. The market has said, we want profits. Show us your path to profitability. They both brought up their inflection points and when they're going to turn profitable materially up to 2021. And we think there's enough levers that they can pull to do that. So, yes, we like the assets. The market opportunity hasn't changed. The companies we only had 1 or 2 quarters. They've executed reasonably well.
Is it a short-term opportunity insofar as if they get to profitability by 2021, they will have also had to reduce the growth rate to get there?
I don't think so.
This is the ultimate balancing test here, right?
I don't think so. Our mutual friend Mike Isaac in his book Super Pumped, I thought what he highlighted there was just how inefficiently the company was run before. It was gunned for growth. So if you do that, that means somebody coming in who's a little bit more efficiency-oriented, like Dara Khosrowshahi, can come in, take out some of those excess spending initiatives, and still manage the company for growth. Look, the market opportunity is still as good as it was before, and you've got these 2 actors acting more rationally. What happened today in New York City? Juno just, the distant third ride-sharing service just went out of business. The markets are consolidating, and they're rationalizing.
What about the regulatory risk that certain cities, states, municipalities, countries say, you know what? These drivers are employees. That's just what they are. I mean, you look at what they're trying to do in California, and the approach that, and I was actually asking Dara about this a couple weeks ago at the Dilbo conference. This idea that the way the law is, the whole thing was structured was effectively to deal with Uber and Lyft, and now Uber and Lyft are saying, actually, this doesn't apply to us because we're a platform. How can that be? I mean, do you actually think they're going to win those cases?
Out of my field, the legal stuff, but absolutely some of their drivers should get benefits. Those who work with them, 30 hours a week, and there are a good number of them. The truth behind these gig economy companies, however, is that the vast majority of their drivers aren't. But there's a way. There should be some sort of compromise there in the middle. How long it takes? My guess is that this is like a year or 2 slog before we really see what the business.
Okay, so look at Lyft here. We got Lyft at $44. 12 months from now, by the way, down, we should say, year to date, almost 40%.
Yeah.
So 12 months from now, what you say the upside for this is what?
I think something like this can go up 50% in a short period of time. That sounds like a big jump. Stock going from low 40s up to 60. But just these are very volatile assets, and when you get these inflection points in profitability, we've seen in the past these stocks.
It's like Facebook.
Yes.
It's a good example. Facebook was a mess after the IPO and then turned around.
Amazon was a mess for multiple years. Like if you have companies that are if they have good execution and they face large market opportunities, investor sentiment will swing on these. Look, right now we're in a risk-off market, so who wants loss-making companies?
Is this fair or unfair? On the screen here, you see we're writing beat in IPOs, worst may be over. Worst may be over for Uber and Lyft. But I can go down that list. You can look at Slack, which everybody thought was an enterprise, great enterprise company. I still think it's a great. I use it every single day, and yet it's off materially. What are the other ones, when you look at the rest of the bunch, are there others you touch or no?
Yes, one that's not this year, but last year was Spotify. I think that stock has gone way up, way down. It's right back at par. You didn't need to buy it in direct to listing. You could just buy it now at the exact same price. But I think some of these that reach those profitability inflection points, Snapchat's another one. Snapchat, Pinterest are both going to turn profitable, meaningfully profitable next year for the first time ever. Investors, there's a new group of investors that'll come in at them because of that.
And so which ones don't you touch? I said Slack, and I noticed you did not get behind that.
Yes, no, I didn't, because I don't cover it, so that's why.
That's why. Is there anybody else that you would not touch, though, that you do cover right now?
There's a good number of stocks that we don't recommend and we're cautious on. Usually, though, it's ones that, even if they're profitable, have gone X growth. eBay comes to mind. TripAdvisor comes to mind.
Does this dynamic around these listings, these public listings, direct listings, does this change the model for you? I mean, do you think that we've now seen what happened with Spotify, we saw what happened with Slack, we've seen what happens in an IPO? Do you think that there's any lesson from all of this that's going to change how investors approach IPOs?
I don't think so. And by the way, I think there are very few companies that can pull off direct listings. You have to be in a position where you don't need cash, and you have a good enough brand name that you don't need it to educate investors. There's very few companies that can do that.